Hey guys, welcome to the impromptu live session where I do all my best voices and all my best impressions of a petroleum engineer and a professor. I appreciate you being here. Let's see if we can make up some time. Look, what I want to talk to you about is what I think is going to happen in the next decade. The next decade is not going to be anything like the last decade. I think we're in for a whole new game, not least because of where we are in the life cycle. The strategies that work in the oil business follow from the life cycle, what's going on in the field and what's going on in the context in the basin or the play or the country at the same time. Now, this graph shows how production will start low, come up and down, and it shows the different strategies that people employ at different times. And it's obvious as these are things that we recognize. Now, let's put that in context for the U.S. This graph deconstructs the total U.S. production into its three main parts. Miller-Darcy reservoirs, which peaked in 1970, before I was born. 30-something basins, overlapping development, first one and then another. There was a time when, in the 1890s, when the epicenter of global oil production was the state of Ohio. But we've progressed, and conventional production peaked here 50 years ago. Alaska came along a little later, peaked in 88, and shale oil production peaked probably just before COVID. Now, this is a forecast, not actual data, obviously. And it looks like a pretty steep decline. It is, in fact, 1 decade from that line to that line. So it's a little tricky. The point is, we're at a different stage in the life cycle. I like to drive the point home a little further. This shows different oil companies that were famous at different times in history, and you can see how their strategies evolved. Easiest to note is Hilcorp here. Now, I actually had an opportunity to join Hilcorp, John, in the mid-90s.
Oh, yeah?
Yeah, my partner went to work there as chief reservoir engineer, but I didn't want to go work for a small company that just started up by some friends of his. Oops, don't judge. But look, today we're talking about a different strategy. We're at a different point in the life cycle. We're no longer midway down the decline where there's lots of acquire and exploit redevelopment to do. We're at a different stage. So if we do want to add production, we have a couple of choices, but mostly exploration is very, very mature. We're talking about seismic to post-seismic plays. The targets are smaller and smaller than they have been in the past, and they're also more difficult to understand. Most of the plays that exist, and I know of several that are profitable at these levels, and I do understand them, but mostly they're plays that are difficult to understand, that have stumped people and caused producers to make poor wells in the past. Low resistivity pay, naturally fractured reservoirs, water-sensitive formations, those kinds of things. But I tell you, there's one place in particular where that strategy might work, and that's uphole of shale plays. So we've drilled tremendously dense well control over multi-county areas, and I've seen other people who've produced pay uphole of the Eagleford, uphole of the Fayetteville, and we have the same opportunity in the Delaware Basin. Published a paper for AAPG this summer on uphole in the Delaware Basin. But those opportunities exist. It's not that exploration doesn't exist. It's just smaller and harder. And the most of the production that's going to continue is going to be shale. Now, what I've drawn here is the kind of redevelopment, acquire and exploit, that might exist. If you've got the acreage, you can go drill it. And we've already started downgrading the acreage that we're drilling. We've already started drilling progressively lower quality rock. Now, we're still drilling some of the best areas, but on average, lower quality rock. And that secular trend will continue. There are a few people who believe we'll see another peak in oil production. from shale oil but there are not very many people who think that's going to happen. It is possible that we'll have some sort of redevelopment in the future. There are three candidate technologies, or there were three candidate technologies. The first was downspacing, drilling our wells closer and closer together. We tried that, John. It did not work. Famously failed. And there's no prospect to be able to reverse those physics so that we can in the future put wells at 450 or 500 feet apart. Now, there are two other things people have been trying. One is enhanced oil recovery. I've been following it since 2016 or so. That is the idea of injecting ethane, in particular, into the formation, letting it sit and producing it back. And the second is to refrac the wells. I started working on refracking in 2002, 2003. And both of those techniques can make more oil and gas. Well, I should say more oil in the case of EOR. You can't make more gas from EOR. But the thing we haven't figured out how to do yet is make more money consistently. Lots of experimentation, lots of tests, and sometimes they make money, but not consistently enough. So if this price is high enough, or if costs decrease, we could see widespread redevelopment of shale oil in such a way that would significantly improve production. And that's a great opportunity, a great option value if you already own the leases. The problem with both of these strategies is that you have to already own the leases. The land rush has been over for years. And the thing I'm hearing more from operators this year as a strategy than I've ever heard before is non-op working interest wellbore only. I've talked to a number of operators who don't have a significant position, but are buying individual wellbore rights, right to participate in a single AFE that's non-consented by someone else. Interesting strategy, but that's a telltale measure of just how little there is available if you don't already own the acreage. I'm going to move this around. Now let's go on down. If what you own is old legacy production, well, you're in a different ballpark. Now, if what you own is in Alaska, congratulations. Let me know if you need anybody to go fishing with you. Hillcorp came to the U.S. onshore in this time period of life when it was well past peak and they could acquire and exploit. And now they are in Alaska at a similar point in the life cycle. Detour aside, the production from old Miller Darcy fields is very old. The average age of a vertical well in the U.S. is well above 40 years. We're talking about stuff that's way, way past its decline. And consistently for years, I've seen a significant portion of the wells in the sales package already be idle. They'll already be shut in. It used to be 25%. And what I'm seeing more consistently now, it increased. Now I'm seeing consistently 50% or more of the wells in a package are already shut in. Now, on the aggregate, I don't really know. In the aggregate, I don't really know what's going to happen. And I don't think it matters all that much, whether it's a flatter decline or a steeper decline going forward. But because you own what you own, and you're going to buy something here. And the question is, what's it going to do? So anecdotally, I can tell you that the fields I've studied tend to accelerate decline at the end, as shown here with the red dashed line. It's not a rule. It's not a law. It's just a pattern that I have qualitatively observed. And that's something to be aware of, something to be careful of and watch out for. The production is most uncertain. The cash flow is most uncertain at the very tail end of life, when maybe it stays on another year, maybe it stays on another 10. talking about high risk cash flows. The thing we got to do is reduce our operating costs, or as sometimes people say, we're going to reduce overhead, which means we're going to cut people's heads off. But we've got to be efficient. We can be efficient also with our workovers. If we can figure out how to do those less frequently, then we have a big chance to improve costs. A single workover is 3 to 12 months worth of operating costs. But whatever you're going to do, if you own these old fields, the name of the game is costs and planning for the end of life. Now, let's put this in context, because the US is not in the same place in the life cycle as the rest of the world is. Now, the left is the same graph I showed you before. That's the 3 component parts of the production from the US. And on the right are 6 other countries in the world showing their oil production. A very large scale here. We're talking about 60 years again. Now, people have said, and rightly so, OPEC has a much lower finding and development cost. True. Much lower operating cost. True. Also lower emissions. But those are abstract. There's some interpretation involved. But this is concrete. This is unambiguous. The United States on the left is 50 years past its peak conventional oil production. None of these other players have yet begun to peak, and none of them have begun to produce their shale reserves. Which is to say, new supply is much more likely to come from the rest of the world. Now, what we have in the US is more mature geology, but also a system that's more distributed, more entrepreneurial, more innovative. That's the reason that we've given the world shale oil. There's no other place on the planet where it has been reproduced yet, even though the technology largely exists. The other components necessary, or the other components that made it work as fast as it did in the US, don't exist anywhere else. And that is probably going to be our strength going forward. Now, people have said, well, oil's not going anywhere, and that's true. And it's also important to note that demand is not the same thing as price. This graph from the IEA shows the full range of forecasts. And again, I'm dealing with a 50-year time scale here. There's a glacial time scale. The 10 years we're talking about is just this area in the brown. Now, the full range of future oil demand forecasts range from a plateau with a 1% decline all the way down to a 5% decline. Oh, 5% decline rate. Yeah, it's not going anywhere fast. Now, as of last year, none of the major forecasting agencies, IEA, EIA, OPEC, ExxonMobil, BP, none of them show significant growth for the future of oil demand. Now, they do show growth in liquids demand. The difference, of course, is natural gas liquids. The most aggressive forecast for oil demand growth was in last year's iteration, OPEC. They called for a couple million barrels a day more, and then a long plateau and slow decline. They did one alternative scenario that put peak oil demand in 2030 and said that that's not nearly as aggressive as near term as the demand could peak. So there's consensus across the board that the world is in various stages, various degrees of turning the boat. Maybe we turn it faster, maybe we turn it slower, but we are turning it. And what the bigger challenge to our industry is what happens when the second derivative changes. What happens when we no longer need to grow supply every year? We no longer need to replace the underlying decline and meet new growth. We only have to partially offset the underlying decline. The production engineers are going to be around the longest. That's the reservoir engineers, the geophysicists, the landmen, who are preferentially going to lose out. The people more involved in initiating the projects are going to be the ones who are going to have less role to play in the U.S. in the short term. But fortunately, demand does not equal price. What matters is the relative balance of supply and demand. And so we could have 50 or even $150 oil when demand is all the way down to 40 million barrels a day. The thing that Spencer Dale said, Spencer Dale is Dale Spencer, I believe it's Spencer Dale, the BP head chief economist. I've followed his work for years. Really great work. He said over the summer in their release of the statistical review, he said, this situation is custom made. It's a textbook perfect example for an oligarchy. And that's what we can expect from OPEC. We can expect not that they're going to try to keep prices high, but that they'll try to keep them low and stable. High enough. On the one hand, when prices get too low, they don't make enough money. They have in the last 5 or 6 years, both OPEC and both Saudi Arabia and other OPEC nations have rearranged their national budgets so that in Saudi Arabia's case, their 2021 budget balances at a Brent price in the low 50s, which means they can survive just fine with WTI in the 40s, high 40s. But if they let prices get too high, then they create demand destruction and they create competition. What they really want to do is have people trust, rely, invest in oil and for the long term. And they want to sell their oil and not someone else's. I don't suppose I could say that under testimony since I don't know their motivation. This is exactly what my motivation would be. This is what makes the most sense to me. Now, OPEC doesn't always cooperate, but that's actually bad news. A failure to cooperate in OPEC means lower oil prices for us. Now, that is oil, and oil is separate from gas. The life cycle of gas is at a different place. Now, shale oil could explode on a global scale and did, in fact, rearrange global supply and demand, much larger market. But natural gas resources with the shale revolution exploded, but they exploded in a container contained inside North America. This graph shows in black here how wellhead production increased, and in red how price came down. I'll show you a table in a second to drive it home. This wishbone plot says demand went up hugely and price came down hugely, almost double up, almost double down, just because the supply so outstripped the demand, even when the demand was growing. But at this point, that transition's over. Now, you may recall Sharif Suki, I believe was his name at Sharif. Did I get that right? Sharif Suki, Cheniere was going to bring natural gas into the country with LNG because we didn't have enough to meet the growing demand for natural gas power plants. And Aubrey McClendon's big bet in the 2000s when he was aggressively buying natural gas from everybody he could was the same thing. We didn't have enough natural gas to support all of the demand that was going to be created by new power plants. But then that turned around. And for more than a decade, demand grew. And every year, the EIA was forecasting higher and higher demand in the future. In 2020, the sequence of increasing demand forecasts stopped. And in 2021, the EIA's demand forecast for electricity in particular actually came down. We've built up all of the demand that industry and the market could justify in the environment at $3 gas. And that we had some great benefits from that. For our emissions and for our businesses. But at this point, the outlook for demand growth in gas in North America is relatively small. There's only a little bit more demand forecasted from LNG exports, although it's possible we'll see a second wave of LNG exports, which would meaningfully increase demand. The electricity conversions have been done. Transportation is not moving. So what we've done is locked in. We've about put in all the demand we're going to and locked it in. But at the same time, our supply rearranged completely. We were producing about 65 BCF a day wellhead, and it was coming from all over. Mostly it was going up towards the Northeast. Well, that turned around, and the production now comes from the Northeast, and the consumption is mainly on the Gulf Coast. We used to be drilling in a wide range of areas. I'll show you a table in a second, but it concentrated. Only the best plays survived. And our three best plays, the three surviving plays are Utica, Marcellus, and Haynesville. And they make up the largest portion of production. And those grew enough to offset the decline everywhere else. They displaced the decline everywhere else where there was no investment going on. There hasn't been a gas-directed rig in the Permian Basin since 2014, which blew my mind. Now, not that people haven't drilled gas. They found it in the Delaware Basin looking for oil. But at this point, all of the pipelines that have ever been proposed to leave Marcellus and the Haynesville, the Marcellus and the Utica, to move gas down to the demand centers have been built. There is no more spare capacity and no more capacity coming. Now, there is a little bit of expansion being performed around Haynesville, and that's because the Haynesville competes with Appalachia for that last mile of pipe. The upstart of that is that the rest of the world has to start carrying its weight now. 10% of our gas now comes from associated gas, up from what it was before, but the associated gas is not going to grow either. This is going to decline, although not as fast as oil itself. So this really, really blows my mind. This is the metamorphosis before and after. We used to be producing 65 BCF a day wellhead wet. Now we have to produce about 115 BCF a day. We used to, in order to meet those 65, run 1,400 rigs. Now we run roughly 100. We were drilling in 14 basins. Now we're drilling in 2. The price, meanwhile, halved. We went from needing imports to needing exports, where the last two are probably the most interesting. Our storage is half of what it used to be. Demand grew, supply grew, storage did not. It's remarkable to me that during this 10, 15 years of growth, including some really, really steep demand growths like this and this, the gas was there. There were no shortages. But storage has historically played a critical role in balancing the market. What we would do back when we still cared about natural gas, the last time we cared about natural gas, because we care again now, is we'd watch the storage numbers. And when the storage volumes trended a little above the 5-year line, well, that meant we had extra gas we didn't need, didn't have a place for it, and we'd choke it back. Price would come down and supply would come down. Conversely, if volumes are trending below the 5-year line, we have too little gas, we might not have enough, price gives a signal and the supply comes on. Now, that supply and demand balance pre-metamorphosis laid on top of an underlying decline of roughly 10% per year natural decline of existing gas production. And we had 50 to 60 days of storage. Now we have 30 to 35 days of storage when it's full compared to the volumes that we use. but the underlying decline on average through the whole system is around 25%, even higher in Appalachia and Haynesville. What that means is we are very delicately balanced, and that is what's happened this year. People have recognized demand was coming back because we lost a lot of gas demand. Demand was coming back, and we didn't have the pipeline. We didn't have the development coming. So in the U.S. at this point, I see the market with three cogs and some oil. Appalachia and Haynesville are supplying the bulk of the gas, and they're competing against themselves in full pipes. And their job is to run the 100 and something rigs necessary to keep their obligation full. They've got a steep underlying decline. I'm going to guess it's on the order of, I'm just guessing it was north of 25. So they have to delicately balance their drilling. Because remember, it takes 4 to 6 months from a spud even to first production. So longer lead for the decision. And if that gets out of whack, well, then storage can't handle it very well. And that combination of steep declines and little storage creates volatility, like we're talking about right now. That means good things for Henry Hub natural gas prices. That's where the second cog comes in, and that's exports. The United States is right now the number one LNG exporter in the world by capacity, more than Qatar, more than Australia. And a lot of the capacity, about a third of it, has been dedicated to the spot market and not to long-term fixed contracts, which is to say it doesn't necessarily have to be sold. As long as the price in Asia, the posted price in Asia and the posted price in Europe are enough greater than Henry Hub to justify the cost of liquefying, transporting, and gasifying, that demand will remain intact. More or less, it'll vary some. But when Henry Hub spikes significantly more than the prices in the other parts of the world, then it no longer becomes economically right side up to export the gas. We have a pop-off valve. We could cut out roughly 5 BCF a day of demand if the Henry Hub price gets too high by comparison to the Asian and European spot markets. So we have a ceiling, a pop-off relief valve. 90 days, the purchaser can cancel a load within 90 days. But that leaves then the rest of the world. The rest of the Mid-Con, the mountains, Texas, East Texas, the rest of the world has to, at this point, replace its own decline. It can't come from imports and it can't come from Appalachia, Haynesville. We're going to have to replace our own. So what we're going to have to do is create a price signal enough to restart drilling in Texas for gas. My first guess, and it is just a guess, is that a couple of the plays in Texas are the best positioned, the gas side of the Eagle Ford and the gas side of the Delaware. But older production like the Fayetteville or the Woodford, those probably stand to benefit along the way from higher prices. So with that understanding of this point in the life cycle, what are the opportunities? Well, they're not all that different from oil. Even though markets may be different, the point in the life cycle is not all that different. Still extremely mature conventional Millidarcy production. There is opportunity to look uphole. There is an opportunity to look for things that are seismic to post-seismic. Certainly the opportunity to reduce your overhead, operate more efficiently, improve your uptime, and drag out that late life production. There will be some more development, I believe, from more of the secondary gas shales. That's probably going to be the next most cost-effective place to get new gas, places like the gas window in the Eagle Ford. Of course, we We don't have the ability to downspace. We don't have the ability to use enhanced oil recovery, but there may be some redevelopment potential in natural gas from refracking. Of course, that again presupposes that you own good rock. You own good rock. Now, whatever your strategy is going to be, whether it is to expand volumes by purchases or drilling, or even just to continue operating, it's going to require capital. It's an absolute cliche that we are a capital intensive industry. Now, we can do all these things about our volumes, but we still have to deal with capital. Now, I tell you what, it's easier to list the places we can't get capital anymore. Wall Street has consistently let us down, not let us down, turn their backs on us. The banks available to make loans for oil and gas reserves halved again during COVID, not the first time. And it's on the order of 15 to 20 banks total in the US who will lend on oil and gas. And private equity has not disavowed, but largely refocused out of the space. I like to tell this story. I was at NAPE in the summer, 320 booths, only 4 related to finance companies. And this was supposed to be the big NAPE for this year, right? Because of COVID. 4 finance companies, 2 were investment banks, meaning that they're a professional services firm, 1 bank, and 1 project lender. There were 0 private equity companies exhibiting at NAPE, whereas Hart's Energy Transition Capital Conference coming up later this month is heavily attended. I counted 10 or 12 private equity, oil and gas, or I should say energy, new energy companies, sponsoring, speaking, or exhibiting. So most of what people are having to rely on is cash flow, but the private investors / alternative lenders are stepping in. They see some opportunity. Perhaps the funding has stepped too far away. There are some of these guys showing up on the market that are really interesting fella earlier this week who's offering VPPs on the order of $3 to $40 million for, I've never seen a volume production payment that small, but this is going to be the kind of capital that is available, creative capital, mostly smaller. Now, as an aside, let me point out here that I've heard people complain that Wall Street is stupid to turn their back on us, as if they weren't entirely focused on returns. But this is an excerpt, a pretty noisy, confusing excerpt from a McKinsey & Company study that's a year and a half old now, but a very fine study. The point of the exhibit is twofold. One, the returns of oil and gas have fallen. And 2, the cost of capital for renewables is less. Therefore, the profit difference between what you can expect to make and what it costs to get money is better in renewables than it is in oil and gas often. It does make financial sense. So and all that to say, I don't see a savior coming back into the market to bring a whole bunch of new capital. At this point, if you buy something, if you can get money to buy something that's producing, you better plan on burying it. If you buy it, you better plan on burying it. There's no guarantee that 1, it'll live all that long, but 2, that someone else will come along and take it from you. But volumes are only part of the equation, right? I do think there's some significant work that we can do to improve our finances, our businesses on prices and on costs. And costs at this time of the game are huge. The volatility that we've talked about makes for great opportunity for hedging. Now, I have said, and I still believe, that oil price at 70 or above is a sugar high. I think that we'll see more OPEC intervention. We have begun to see them intervene and bring back online several of the part of the several millions of barrels a day of capacity that they have at their disposal. I think when we start seeing the out prices of the NYMEX strip move up, and we see rig count start turning up again, that's when we'll see the market turn around. That's when we'll see OPEC take action, and then prices will come back down. We certainly need to focus on our costs. There are a lot of things that we can do there. It's been popular to talk about machine learning, but I haven't figured out yet how it works. I know there are a lot of smart people spending a lot of effort on it, and I'm waiting to see them show up with a way that actually does reduce our cost, that makes a difference. Now, pump off controlling or lift control, now that's clearly a winner. We also have the opportunity for basin level consolidation, something a little bit larger and something a little smaller. There are a lot of gas plants that are only a fraction full. And companies like Presidio and Colin, who are on the cutting edge of this new wave of strategies, have both avowed a basin level consolidation strategy. Now, I tell you what we shouldn't do is make Copus a profit center. I saw a guy trying to sell an asset base. He had, I don't remember, a number of wells on the Eastern Shelf in Texas. He was operating. He had over decades drilled the prospects and kept a minority interest in them. But his Copus income was about 4 times his working interest income. He was keeping the wells online to collect Copus. That's not cool. But look, yeah, that's operate somebody to death. The biggest opportunity in front of us, though, is the energy transition. Now, that I know people have been worried about it or said it's not going to happen or been scared of it. I see this as the biggest opportunity and the next big boom. Most of the pieces are in play. The public, let's start here with investors. This graph shows membership in the Climate Action 100 initiative to put pressure on public companies to reduce their emissions. And you can see since it began operations of ages ago in 2017, it has steadily grown the dollars under investment or under management that are committed to the initiative, and the number of investors. They're at over $50 trillion committed. Now, this data point is hard to summarize. It's not centrally located as that one, and this is only one initiative, but a marquee one. Last year in 2020, BlackRock kicked off the trend of committing entirely to divest entirely of fossil fuels. That's already over 10 trillion by reporting last year. Don't know what it is now, but we can expect both of those trends to continue. Look, and the public, believe it or not, is actually in agreement that we need to do something about transitioning our energy as well. Now, there's always a lag between some sort of commitment and belief and action. So the middle number shows that 58% of Americans, this comes from 2 surveys within the last 10 months. I just showed the results from one of them, but a little more than half of Americans understand that the earth is warming, that the climate is shifting, and that that's caused by human activity. Now, in a election, the 58% would be a landslide, but a little more than half. That's not particularly new, but what is new is that people are reporting taking personal action. In the University of Houston survey, 31% of people said in the last year, in the last 12 months, they had made a no purchase decision on the basis of the company's stance on climate change. That is real action. Another survey by University of Houston found that people were willing to pay significantly more, attested to be willing to pay meaningfully more money in order to have cleaner products, cleaner fuels, cleaner electricity, for example. But on the high end of the range here is consensus that we need collective action. 72% in the one survey and about the same in the other support regulating CO2 as a pollutant. That is to say, 72% on that order believe we need a carbon tax. You don't have to necessarily believe that humans are the cause to believe it's worthwhile to take action to mitigate. And I tell you what else, there's also not quite as high a majority opinion about, but there's also consensus that significant investment in new energy is good for the economy, will create more economic growth. So companies and countries, other countries, are also stepping up. This comes from the BP Statistical Review of World Energy from last summer. And it shows the number of companies and the number of countries, or it's actually measured in emissions, that have committed to net zero. These are commitments which lead and have only recently been made, but these are escalations of commitments above the commitments made to reduce emissions, as we saw in the Paris Accords. We're seeing it. The standards, the promises are increasing. The number of people committing to them are increasing. Now, the energy transition, this is going to take 30 years plus. This is not a single step process. It's not a single answer process. It's a complex, parallel, generational evolution. The biggest piece that's missing right now, though, is the government. There are government in the US, there are some actions taken by cities, by states, to set things like minimum generation standards so that you get a certain amount of electricity from renewables. Subsidies have been in place. Those are rolling off. The most important thing that we have right now is the 45Q tax incentives for carbon capture, which were increased in 2018. And the only direction they might move is up. But there could also be a carbon tax. And this is mind-blowing to me. The environmentalist lobby and the oil lobby in the form of the API and all the majors, to my knowledge, support a carbon tax. I read a story just this week about a major utility saying also we need a carbon tax. So right now, the costs of emitting this colorless, odorless gas on a gigaton scale are diffuse and shared by everyone. It's not part of the economic system. But if we can take those external costs and translate them into the market with a carbon tax, then we have a boom on our hands. A $50, $100, $200 carbon tax all of a sudden creates a massive economic incentive to do what is good for us anyway. The good news is oil and gas is in the right position for that. The number one leading technology that needs to be deployed in the near future is carbon capture and storage, and that uses our science, our knowledge, our skills. I see it as a great opportunity. Now, the world has been through a couple of revolutions in technology in recent years, not all that recent. I've got an example here from a couple from the internet, from tobacco, and from digital photography. There's a range of strategies that are available as the energy transition leaves the gate. You can rely on your incumbent strategy, or even try to protect it, stick to your knitting, so to say. Or you can lean in various degrees to what's coming. In these examples, you can see on the far left are the companies that tried only to protect their incumbent status, their cash cows. There are some companies you see in the middle who leaned in, straddled the fence, and evolved. Philip Morris and R.J. Reynolds, for example, as tobacco was dying, they bought foods. So it's now RJR Nabisco, and Philip Morris bought General Foods. Diversified, still thriving companies today. There are some companies that have leaned in and started on the far end with the emerging strategies and have made a go of it. and have succeeded fantastically. Match.com is a natural fit. I would never have guessed that online dating would have been the real winner in the internet revolution. But you also see in the lighter color here, pets.com, broadcast.com, and AOL and MySpace. These are all companies that began to lean in to the transition and either didn't have the timing right or didn't continue to evolve, and they also ceased. So I like the axiom. It's as old as football itself. The best defense is a good offense. And as of last year, all of the global integrated majors have announced various strategies, one strategy or another, to lean into the transition. Now, the easy stuff is stick to your knitting. And BP said this summer at the statistical review that even when they're done with their transition, they're still going to get about a third of their business, about a third of their profit from oil and gas. It's not that they're leaving oil and gas. This morning, we interviewed Talos. They said they're still an oil and gas company. They've just started a CCS project. And across the board, people are high grading their assets. They're reducing their emissions and leaning into natural gas. Others are leaning into other things more or less strongly. Oxy, for example, is leaning into direct air capture. Fantastic. They've, but they're not very, and Exxon is spending some real money to try to develop that technology. If memory serves, hundreds of millions of dollars. That's not for me. I don't want to bet on that one. But there are a number of strategies that we can employ. I tell you what's going to be essential to getting funding, I believe, is having an ESG rating, being verified as an ESG company. We can all reduce our costs. We can all reduce our emissions. Our product is, really helpful to mankind, except when we vent it. Nothing good comes out of that. Carbon capture is the nearest opportunity. And if you didn't get to catch the interview this morning with Talos, I encourage you to go back and do it. Kind of ended up being a rah-rah session. I'm a little embarrassed, but it was so exciting to me to hear Talos talking about the opportunities that I also see. You might be surprised to know that geothermal comes in 4 varieties, and that 3 of them are suitable in sedimentary basins. And what's even, really 2 of them are suitable in sedimentary basins. One of them suitable everywhere. And the 4th one uses oil and gas technology. Hydrogen is probably coming along in 20 years. I think hydrogen will be a later stage, but there are other things that we can do now. Like I've listed some ideas here. Lithium from fossil waters, pumped energy storage, pumped gas or pumped water energy storage. Fascinating article in the Texas Monthly just last month. And of course, solar and wind are out of the gate. I was at the SIPES conference, the Society of Independent Professional Earth Scientists, in the early part of the summer. And one speaker got up and said he had figured out behind pipe, hard to understand pay. And he had brought on a number of wells between 10 and 40 barrels of oil per day. It's pretty good. Second next speaker was a geologist who started working on wind prospects about 10 years ago. And last year, 2 of his projects came to fruition. Both of them were 9-figure projects. 9-figure projects. So look, CCS is going to have to be big. It's only going to grow, all the uncertainties to the high side. And I was telling Talos this morning, talking with Grant there, what we have to do is reverse the stream. So it used to be, we were upstream, midstream, downstream. Now we need counterstream. And we can get, all of a sudden the emitters are the producers, right? This is the valuable product now. Chemical plants, processing plants, power plants. And then we have the opportunity to grow. But look, I'm going to be wrong. A bunch of this is going to be wrong. Big picture, slow to unfold, lots of bumps along the way. But I love this military axiom. Planning is everything. Plans are nothing. You get punched in the face, as Mike Tyson says, but if you have a plan, you can handle it. And you don't end up like Sears or Kodak. Next spring, I'm going to put on a conference where we're going to talk about, we'll try to get everybody in touch with each other so that we can work together You can find the vendors you need to take advantage of the energy transition and make money. I hope that you can come. But for right now, what are your questions? What are you thinking?